Good evening and welcome to the Earnings Review, your tidbits into company financials and operational insights. Thank you for joining us as we broadcast from Hampton Studios in Harare, Zimbabwe. I'm Ibn Mabunda, your money man. On the show, we engage top echelon executives to get you up to speed with first-hand information. We also chat with the most competent analysts on the market just to ensure you're finished with relevant and comprehensive market analysis. Tonight, we focus on Simbisa Brands, a fast-growing quick service restaurant player on the continent of Africa. Now, Simbisa is a key player in Zimbabwe's fast food industry and is listed on the Zimbabwe Stock Exchange. Simbisa boasts of an outlet network of over 460 spread across 9 African countries and an employee base of over 5,500. The Zim giant operates through 13 brands in the different markets that it plays in. In Zimbabwe, this of course would be the dominant market for the firm as it has over 200 outlets which contributes more than 55% annually to the group's revenue. Kenya would be the next dominant market wherein it has a growing outlet base of over 140. A sneak peek into the firm's timeline. This of course would be one of the exciting journeys in as far as Zimbabwe's business stories are concerned. At this point, it is important to note that Simbisa Brands is formerly a subsidiary of Innscor Africa. Now, the firm's history dates back to 1987 with the establishment of the first QSR Chicken Inn in Speak Avenue here in Harare. 1995 would mark the acquisition of a mechanized bread plant as well in Harare, and in 1998 Innscor Africa acquired Capri Corporation Limited in a reverse listing on the Zimbabwe Stock Exchange, which generated a market cap of 70 million United States dollars. 1998 would mark the acquisition of would mark the opening of additional QSRs in Zambia, Ghana, Kenya, Tanzania, Uganda, as well as Mozambique. That same year would see the acquisition of franchising rights here in Zimbabwe through Nando's, with the first outlet opened in Avondale, Harare. Further on in 2002, 4 additional QSR units were opened in 4 African countries, 2 in East Africa, notably Nigeria as well as Senegal, with the other 2 in 2 SADC countries. By 2005, Innscor Africa had expanded its QSR footprint across 12 African countries with 7 company-owned brands and 5 franchises. 2007 would mark the firm's expansion into Swaziland as well as Lesotho. 2015 would be very much a defining year in as far as Simbisa is concerned, as the firm was unbundled from Innscor as well as listed on the Zimbabwe Stock Exchange separately. 2018 would also be an exciting year as the firm went on to add 46 outlets across all of its units on the continent of Africa. A sneak peek into the firm's modus operandi, a major factor contributing to the success of this emerging African giant would be its strategic outlay in as far as the picking of its outlets are concerned. The firm frequently targets places of significant foot traffic, among them CBDs, frequented food courts, as well as busy track routes. The company operates, as I mentioned earlier, through its own company-owned brands, among them Chicken Inn, Pizza Inn, as well as the Fish Inn. It also operates through other franchises, among them the Galitos, Nando's, Steers, and of course the Rocco Mamas, among other franchises. Some quick stats where the group is concerned: with the current share price of 425 cents, Simbisa has a market cap of 2.2 billion Zimbabwean dollars. The stock has moved 270% north since the year started, vis-a-vis a consumer discretionary that is up over 570%. Comparatively, the ZSA All Share is up 470% to date. Key shareholders in the firm would be, among others, the D Investments, as well as the HM Baba owning 19% and 18% stake respectively. This concludes the Halaju section of our show. In just a moment, we'll be crossing over to an analysis of the firm's operations. Now, don't go anywhere. In this very segment, we get into the nitty-gritties in terms of analysis where the operations of Simbisa are concerned. And joining me for a conversation where that is concerned is our very own Chief Analyst for Equity Access, Respect Quincy. Respect, good evening and welcome to the Earnings Review.
Thank you, Eben. My pleasure. Good evening, viewers.
Fantastic. Now we have quite an interesting firm that has been in operation in Zimbabwe for over 30 years, and over that period has been able to expand its footprint in several African countries. Can you, in a nutshell, just give us the relative importance of that very development in as far as Zimbabwe is concerned, and also in as far as the very entity is concerned, Simbisa?
Thank you. So obviously the company grew organically from the Zim market, starting with that one outlet in Harare, and then today we are speaking of over 539 counters across Africa. And obviously that growth has been phenomenal. But I think it's important to actually give a background to it, to say this is one of the anchor investments of what is now known as Innscor, the Innscor group. Of course, they had to then unbundle the QSR business at some point, but really this is what gave them the engine to grow, to become one of the biggest companies in Zimbabwe. And obviously, the growth that we are seeing now at Simbisa really reflects the kind of investments that had been committed, and also the knowledge of markets and especially the quick service restaurant kind of business. So to me, I think it's really an important business. It's one of its own kind in this country, and obviously when you look at those markets where they also operate, they are quite market leaders in some of those countries. So it really speaks to a real African giant.
Fair enough. Back here to Zimbabwe, which would be the dominant market where they're actually playing in, which contributes north of 60% annually in as far as revenue contribution to the group is concerned. Can you give us the frame in terms of the operating environment that Simbisa has had to operate in as far as Zimbabwe is concerned?
Yeah, indeed. Zimbabwe is the biggest market. The share of Zim has actually been falling over the years because of the expansions. But if you look at the operating environment that we're currently faced in, it's hyperinflationary, exchange rate losses, slowdown in GDP, and now the COVID-19 pandemic. All these factors are obviously militating to weigh on the prospects of companies. But I think one key element there is agriculture, because it is part of the value chain of how you then get to operate a QSR business, and it has been affected by drought over the past at least 2 to 3 years. So this has been a huge blow to the company, because you also have to import some of the inputs there. So it really affects how you then also get to deliver. So looking generally at the environment, it has been quite tough. It has been quite challenging since 2018 to date. But they've managed to grow. They've managed to increase their counters. They've also managed to increase the head count in terms of the people that actually visit their stores. I think all that to me speaks to resilience in a time where things are quite difficult. But equally, when you also look at their offering, it's a value offering to me. Most of their brands are actually value offerings, and they speak to a market that is depressed, the market that is suffering in terms of disposable income, and they've been able to hold fort.
Suffering, you said. A sneak peek into some figures that I want us to look at as far as the most recent trading update is concerned, and as well as perhaps how they fared over the past few years, particularly their trading update for the third quarter to 31 March 2020. The group reported a revenue growth of 958% in historical terms, and inflation adjusted, that was an 87% growth. Can you give us an explanation in terms of what could be informing this very disparity? Because I mean, we're saying 958 in historical, and then a mere 87% in as far as inflation adjusted from figures are concerned.
Yeah, so the dynamics around Simbisa are quite broad. When you look at how they compute their income, they have to adjust earnings from outside into Zimbabwe. So naturally, that would give you exchange gains in a period of hyperinflation. So you would expect inflation-adjusted numbers to really be up there. But equally, when you then look at the Zim market, when you're looking at computation of inflation-adjusted numbers, they have to discount for the impact of inflation, and that's why we have that slower growth. But that growth in historical terms is simply reflective of the adjustments that had to be done in terms of prices. You would know that Simbisa is one of those, it falls within a sector which has been exempted initially in 2019 in terms of payment using foreign currency. The tourism sector had that exemption. So they enjoyed that exemption, and they had to peg some of their prices in USD, and even their local offering had to be equated to a certain rate. So all that obviously meant their income has to go up in nominal terms while holding fort in real terms. I think when you look at the number of the customer count, it really shows a flat figure, almost 1% up year on year. But I think that also speaks to the value nature of their product.
Now, Respect, I want us just to have a sneak peek into their performance over the past few years, moving right up to this point, looking at how they fared dating back to perhaps 2015, where we see a profit position of 7.5 million United States dollars, 2017 5.8, jumping there to $13.9 million in 2018. Then, of course, we've got that significant surge in Zimbabwean dollar terms, where we see a figure recorded of 32.4 million Zimbabwean dollars. What can we read in as far as this chart is concerned?
Yeah, I think it's a growth story. It's a growth story. But if you look at 2016, obviously they had to exit some of the markets. They exited the DRC market. In fact, there was a lot of turbulence in DRC at that respective time. That's why we're seeing a contraction in income there. But over the successive years, especially 2017 onwards, Kenya came in so strong, and its contribution to the top line was actually also going up. So I think that successive growth in the top line, as well as a corresponding bottom line growth, really reflects to the growth strategy and the re-strategy across the region. In Zambia, they had to close some shops, but whilst opening some, it's also a matter of strategy, just changing location and ensuring that you pick those spots where you can actually maximize value. But I also in 2018, that growth also reflects the expansion as well in terms of the number of shops that you're finding in the Mauritius area, and that's where you find that growth coming from. So really, it's to me, it's a function of that growth trajectory in terms of opening new outlets, while also preserving value and strategically exiting some of the markets which are underperforming, and even some of the shops in terms of location. I think that has ensured that they retain high margins in terms of profitability as well as revenue growth.
And then the pandemic came. And this, of course, would be one of the industries that have been hard hit by the national lockdowns and the scare and the fear that comes with being in some of these places of high exposure. What can we expect, or how much of a knock do you think this would have in as far as their operations? I know that we're expecting their half-year financials in the next few weeks. Can you give us light where that is concerned?
Yeah, indeed. The tourism sector, which feeds into hospitality, obviously has been one of those sectors that has been more affected by the pandemic, more than other relative sectors. You could talk of transport, but obviously this sector has been hard hit. The number of people going out obviously reduces in such a time where there are restrictions for people to go out and have fun and also eat out. But I think the numbers that we have seen in Q1 are likely to be significantly changed from those that we are going to see in Q2, because most of these restrictions globally, they came in from a period late March into April, right up until now. So obviously the expectation there is that the numbers in terms of customer counts definitely is going to go up. In Zimbabwe alone, we saw the normal times of business operations had been reduced then to in the first phase of the lockdown to around a few hours, I think half of the normal time, and there's been a slight increase now. So obviously all that impacts in terms of profitability, but also in terms of the revenue. But they have done much in trying to do some virtual services where you deliver at home, your daily delivery, and you also have got these drive-throughs. So they're actually expediting ways of trying to keep business afloat in an environment which is quite tough. So all those, I think, they are likely to significantly impact Q2 revenues and overall performance. But for the rest of the year, we don't expect that we might see a rebound in performance for the greater part of the year, because you would talk of a general decrease in disposable incomes, which may even cause some companies to keep on revising downwards what they might offer in terms of remuneration. So to me, that really seems to be something that will hard hit up until the end of 2020. And COVID is still in sight, no vaccine is yet, and still those restrictions are affecting some of these markets.
Let's talk about their ability to maneuver these tough times, and perhaps it would be important to have a look at their gearing and how they have been able to perform over the past few years, and perhaps giving us an indication of what could be actually taking place within closed doors in terms of liquidity and solvency and issues of such nature.
Yeah, they do have got 1.2 million US dollars sitting in their bank outside the country. This is just cash flow generated by the business. They reduced their debt levels significantly. In Kenya, they reduced the debt of about 6.8 million to close to zero. And they also extinguished their debt in Mauritius as well. So their gearing ratio, which is what's reflected here, it's simply a reflection of their debt to equity. So sometimes when you have a high gearing ratio, it means you are borrowing more. So largely they have stayed above the 50% mark, which is above 0.5 according to this chart. And this reflects that they had a high propensity of debt capital. But in an environment which is so volatile like this, you don't want to be pushing more of your income towards settling debt. You need to preserve capital, you need to reduce your costs. And obviously reducing your interest expense is one of those ways you can actually preserve a shareholder value or maximize the bottom line. But I think more fundamentally, when you reduce your gearing, it means that operationally, when you're under the circumstances that we are in operationally, you demand less working capital. So when you demand less working capital, you wouldn't want to be sitting on a loan that you're not utilizing. So extinguishing part of these debts, I think it's also a reflection of the reduced demands for working capital. And by merely keeping that debt, you are just simply creating a cost for the organization unnecessarily. So for 2020, we are going to see a ratio which is actually below 0.5, which I think is favorable. And they do have got that cash buffer, which should ensure that when they need to expand their number of stores, they can actually increase that.
Interesting matrix there. Now, what can you tell us about Kenya? Over 200 outlets. This would be the second largest market outside Zimbabwe, wherein they have really set their roots there. What can we anticipate in as far as developments are concerned for Kenya?
Yeah, Kenya has been a success story for the company. Really, they are expanding. They've even seconded some of their key personnel from Zimbabwe to Kenya, which shows that it's a focus area. It's also an entry point for that region of that sub-Saharan region. So I think it's going to keep on increasing in terms of contribution. It's a relatively stable economy compared to Zim. They're expected to grow by about 4% initially before these economic vagaries. The growth projection was that it would do about 4 to 5%. But now, of course, yeah, maybe that growth might come in at 0 or so. But then there's relative stability politically. There's also economic growth that the country has been enjoying recently. The United States signed some agreements with the country to expand some of its bilateral agreements to the tune of 10 billion and commit those to Kenya. So I think it's a story that's worth checking over the next few years. But to me, I think they've hit or struck the right chords.
Fair enough. Now let's talk about their arrangement. Of course, they've got their company-owned brands, and then they've got some of the brands that they operate under a franchise sort of agreement. Can you shed light in terms of these franchise agreements? I mean, there's Rokomamas, Galitos, Nando's. How important and how strategic are these, considering that in specific markets, they're only playing with these franchise sort of brands without their company-owned brands?
Yeah, it's also a function of strategy. When you get to a market, you realize which segment do you want to attack and where do you have the high chances of winning, and where do you also have the expertise to outperform your competitors. So if you look at a brand like Galitos, this is a key brand that they have retained, and it's quite dominant in markets outside Zimbabwe, notably South Africa, and also the new market in Mauritius. So I think it really speaks to the nature of the market that you're getting into. If you look at Zambia and you look at the average incomes, when you just look at the average income per capita, it's below $600-700. So that really shows you that people don't have as much spending power. So you would want to enter that market with value brands, and you would name those other countries, your DRCs and so forth. But for these other countries like South Africa and Mauritius, there's a high income per capita, which shows you that they have got a higher segment of that market who can actually pay a top dollar for brands that are not of value nature.
As we wrap up, there's been increasing competition in the Zimbabwean market. We can talk about the mambos, the chicken slice, and of course the eaten lick. How do you think that things will play out in the next 3 or so years to come?
Yeah, there have been attempts to dethrone Simbisa, notably from Chicken Slice. I mean, they've done tremendously well in giving Chicken Inn and the rest of the Simbisa brands a run for their money. But their market leadership is unparalleled. They've continuously been doing R&D to refresh some of their product offerings in the market, and I'm sure they still have got a relatively stronger footing in that. But that's also a function of having shareholders who can respond quicker when cash flow is needed, and those who can also listen to the market, because in this QSR business you need to pay attention to the changes in customer tastes and preferences, and also how these customers are responding to dynamics around retail globally, you need to be as quick. So they have done exactly that, and they still maintain that market leadership. So this proliferation of other players, to me, is just a reflection of an industry that is doing well, and they still maintain that foothold in that space.
In just 30 seconds, what can we expect from their results?
I think obviously the expectation is that the results will be depressed in this financial year. It's a given COVID-19 underperformance of the broader economy and generally harsh macroeconomic environment.
Thank you, Respect, for the perspectives. Thank you, viewers, for staying with us. Don't forget to like, subscribe, follow us on Twitter, Facebook, and to visit our informative website, www.equityaccess.net. Remember to catch us every Tuesday, every Thursday, 7 p.m. Central African Time. From the Equity Access team and I, Danke, and ciao.